right? In the long run, inflation is going to be much, much higher than 2%. And that's what the gold market still hasn't repriced. Gold is still reflecting belief that the Fed's going to succeed and that over the long run, inflation is going to average 2%. It's not. It's going to average much higher than that, probably average closer to 20% than 2%. And when the market has to price in gold, a present value of gold, given a much, much higher future inflation rate, then gold needs to be priced much higher, and it will be. Gold is historically very, very cheap. Gold could be 10,000 or 20,000 with the Dow at this level.
Markets are increasingly skeptical about the Federal Reserve's readiness to implement interest rate cuts, a critical issue influencing the economy's and stocks' trajectory. A high-ranking Federal Reserve official expressed growing confidence on Tuesday that inflation would continue its descent this year, returning to the Fed's 2% target level after 2 years of escalating price spikes. While there is speculation that the Federal Reserve may be on the brink of cutting interest rates, as mentioned by an official on Tuesday, such a move is contingent on further data confirming a decline in inflation. Fed Governor Christopher Waller asserted that, in the near term, inflation is approaching the central bank's 2% goal, creating a scenario where interest rate cuts could commence in 2024. He highlighted the prevailing market belief that the Federal Reserve will successfully maintain inflation at an average of 2% in the long run. Contrarily, Peter Schiff, chief economist and global strategist, challenges this assumption, arguing that inflation is likely to be considerably higher. The current market price is positioned within a consolidation phase, fluctuating between minor support at $2,009 and minor resistance at $2,067. A breach above the minor resistance could trigger a bullish momentum towards the main resistance at $2,149. Peter believes gold is undervalued, anticipating a future shift towards a more affordable stock market. He predicts that the true value of gold will increase, suggesting its price should be significantly higher than its current levels. The eventual repricing of gold becomes imperative as the market recognizes its current value in light of anticipated higher inflation rates, leading to a substantial increase in its price. The U.S. Federal Reserve recently voted to maintain interest rates at a 22-year high, outlining plans for up to 3 interest rate cuts this year, citing progress in addressing inflation. Peter envisions potential consequences arising from rising interest rates, foreseeing a scenario where the Fed may need to intervene and purchase various types of debt, setting off a spiral effect. We will present clips from Peter Schiff's interview with Soar Financially. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
A lot of people are still a little reluctant to buy gold above 2,000 because they've been burned in the past at this price point, to see gold pull back. But the pullbacks have been, narrower and narrower. And I don't think there's a lot of downside risk in gold. I mean, obviously, there's a little bit of an opportunity cost in that you're giving up your interest. But, there's not that much interest. And I think the upside potential is enormous. Relative to, the downside risk in gold from here. I think historically, if you look at, where gold is relative to, let's say, U.S. stocks, relative to the Dow Jones, with the Dow Jones, close to 40,000, and gold at 2,000, gold is historically very, very cheap. Gold could be 10,000 or 20,000 with the Dow at this level. If we're going to get to a cheap stock market, which is what I think. I mean, right now we have a very expensive stock market, based on valuations and a lot of other metrics. I don't think the market should be expensive. The market should be cheap, and eventually it will be cheap, but it won't be cheap in dollars. It'll be cheap in real money. It'll be cheap in gold. But the other reason I think gold prices go much higher is, money supply and inflation. And not only how much inflation we've already created, but how much inflation is going to be created in the near future. And, you asked me earlier about, inflation. The inflation is all about money. We had a huge increase in the money supply, and that's the source of the inflation. That is the inflation. The impact that has on prices is a result, and we're focusing on prices, and we're not looking at inflation. And that kind of lets the government off the hook for creating it. What's going to happen to money supply as the interest rates really start to move up, because nobody wants to buy treasuries. I mentioned earlier, somebody's buying treasuries, but eventually nobody's going to want to buy treasuries. And everybody who owns treasuries is going to want to sell treasuries. And that means the only buyer is going to be the Fed. But it's not just going to be treasuries. No one's going to want to buy any US dollar denominated debt, because none of the borrowers are going to be able to pay rates high enough to cover the loss of value of the dollar. So then the Fed might have to start buying municipal bonds, corporate bonds, everything, and it's just, just a spiral. And so it's not just that we've had so much inflation in the past, but that we've got so much inflation that's already baked in the cake for the future. That's why the price of gold really needs to start to rise to reflect that. Right now, people just don't get it. I mean, people are still optimistic. They're still confident in the Fed. They still don't understand, what's about to happen, because they don't understand what already happened. They still don't, know, how the Fed created all these problems, how it inflated all these bubbles. They still think we have, genuine prosperity as opposed to a gigantic bubble.
One of the notable financial trends in 2024 is the de-dollarization movement, where an increasing number of countries, including India, China, Brazil, and Malaysia, aim to diminish the dominance of the US dollar in global trade. These nations actively explore trade channels utilizing currencies other than the US dollar. Observing this shift, Peter discerns a dynamic transformation that no longer favors the US dollar as the world's reserve currency. Initially, when the dollar assumed the reserve currency role, it was backed by gold and redeemable in gold. However, the present scenario depicts the US as the world's largest debtor with substantial trade deficits. The global economic imbalances have become unsustainable, and the US increasingly relies on other nations to finance its debt through investments in US bonds. Expressing skepticism about the sustainability of the 2% inflation target, Peter anticipates a potential return to high inflation or even double-digit inflation. This could make US debt unattractive, potentially unraveling the dollar's status as the world's reserve currency. Peter asserts an inevitable need for a replacement, pointing to gold as the most probable alternative given its historical significance and the current lack of viable options. Let's get back to the interview.
The dynamics do not favor the dollar as the reserve currency. Remember, when the dollar became the reserve currency, initially, number one, it was backed by gold. And it wasn't just backed by gold, it was redeemable in gold. But also the US was the world's largest creditor nation, and we were the world's largest net exporter. We had huge trade surpluses, and we were this gigantic creditor. So it made sense. Everybody needed dollars because everybody wanted to buy our stuff. We made all the cars. We made all the radios. We made all the appliances. I mean, all the manufactured goods were made in America. And so people needed dollars to buy all our stuff. But, flash forward to today, we're the world's biggest debtor. We have the world's biggest trade deficits. What do anybody need dollars for? No one needs to buy our stuff. We don't make the stuff. So people have been recycling these surpluses into our debt, into our bonds. But we owe so much money that it's obvious that anyone holding our bonds is holding the bag. They're going to take losses. So it doesn't work. And we have these global imbalances, huge economic imbalances, because Americans live beyond their means. We spend, but we don't save, or borrow, we don't save. We consume, but we don't produce. And this is a gigantic burden that we have imposed on the rest of the world that has to subsidize this. And the cost is getting higher and higher and higher. And so it's got to come to an end. And I think we accelerated the process early in the Biden administration with these sanctions on Russia, where we weaponized the exorbitant privilege that the world has given us against Russia. And we made an example, and we basically a warning, hey, if you own dollars, you better do what we tell you. Or, we have the ability to punish you. And I don't think China is happy to be in that position. I don't think anybody wants to be in a position where the US has that kind of power. So I think we've created another political incentive on top of the economic incentive to de-dollarize, to move away from the dollar. And, one of the things that happened early on in the 70s when we went off the gold standard, that's when we got Saudi Arabia to price oil in dollars. So, okay, well, you couldn't get gold for your dollars anymore, but at least you can get oil. We created the petrodollar. But, the world is moving away from that. I mean, more and more trade in oil now is occurring in other currencies. And so this process, I think, is going to accelerate in the years ahead, as this, debt bubble explodes and we have to go back to QE, whatever we call it, in the face of escalating inflation. And then people realize that 2% inflation is a thing of the past if we ever actually had it, and it's going to be high inflation or double-digit inflation as far as the eye can see, and that means negative real rates on treasuries and U.S. debt, and nobody's going to want to hold it. And so then you're going to get this unraveling of the dollar, and then there's no way the dollar can be the reserve currency if it's losing that kind of purchasing power. So there has to be a replacement for it, and the most likely alternative is gold. A lot of people, and it's very conceited.
Gold is rising due to geopolitical risks and anticipated US rate cuts. However, it's set for its weakest performance in 6 weeks, influenced by a stronger US dollar and increasing bond yields. What will drive future changes in gold prices, considering geopolitics, US rate expectations, and market dynamics? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.